Good day, everyone, and welcome to Module 13, Stockholders' Equity of Financial Accounting, Reporting, and what is FARS? Is that it? Financial Accounting and Reporting. Sorry about that. Today, we're going to focus upon stockholders' equity. So please turn to page 515 in your Wiley textbook. Now, I think most of this information should be relatively straightforward to most people, although there are a couple of topics that you may not come across on a day-to-day basis. So what I'm going to do during the first portion of this tape or module is go over the concepts and principles, and then in the second part, I'm going to try and do as many of the questions at the end of the chapter as possible. Okay, so here we go. Stockholders' equity, page 515, is the residual of assets minus liabilities. Due to the number of fraudulent manipulations involving stocks, many states have legislated accounting for stockholders' equity transactions, and they are controlled to some degree. So to prevent fraud, a lot of states have some restrictions or requirements on the amount and level of stockholders' equity that must be present in any corporation. Common stockholders' equity consists of two major categories: contributed capital and retained earnings. Retained earnings are either appropriated meaning they are going to be used for a particular purpose, or unappropriate, which means that they can be used to pay dividends, etc. Paid-in capital, contributed capital consists of paid-in capital in excess and legal capital. Legal capital is the par or stated value of a stock. So, page 515, they gave you a breakdown of this information. Now, in the middle of the page, they say, when significant changes in stockholders' equity accounts occur, enterprises are required to disclose them. Most companies satisfy this requirement by using a statement of changes in stockholders' equity. And they give you exactly what the statement looks like at the bottom of the page. These statements show changes in the number of shares as well as the amount of dollars between balance sheet dates. So look at this, become familiar with what a statement of changes in stockholders' equity looks like. All right, on to the next page, which is page 516. Now, know these journal entries. The entry to record the issuance of common stock. Again, notice that you're always going to debit cash for the amount of cash that you receive when you issue stock. You're always going to credit common stock or common stock par value for the total par value of the shares, i.e. par value dollar amount times the number of shares being issued, and then you're going to credit paid-in capital in excess of par for the remaining amounts. Now let me also say that paid-in capital in excess of par can also be called additional paid-in capital. So paid-in capital in excess of par is also known as additional paid-in capital. All right? Sometimes it's also called contributed capital in excess of par. Okay? Terms are familiar, but generally this account is a plug account, meaning we would credit this account for the difference between the total cash received at issuance and the total par value of the shares being issued. If stock is sold for less than a par, a discount is recorded. A discount account is debited. I think you're rarely going to see situations where stock is going to be issued for less than par. So I wouldn't really focus upon that. I wouldn't. It says control accounts are occasionally used to control unissued stock. I really wouldn't worry about that either. Now, it says no par stock is occasionally used. When you have no par stock, all of the proceeds from issuance of no par stock are just credited to the common stock account. Because obviously, if you don't have a par, if there's no par value, then you wouldn't have any excess of par. Okay? Now, Part B, page 516, contributed preferred stock. As implied, preferred stock has preferential rights, most commonly the right to receive dividends prior to common stockholders. Generally, the dividend payout is specified as a percentage of par. So, what you're going to do to calculate the dollar dividend per share on preferred stock, you're going to take the par value and then multiply it times the percent that is given. So we have 7%. So for example, 7% par value stock, if our par value is $100 times 7%, then our par value is, then our dividends per share are going to be $7 per share. Okay? So now there are various kinds of preferred stock. There is participating preferred stock. There is cumulative preferred stock, and this is important. When you have cumulative preferred stock, dividends not paid in any year, which are called dividends in arrears, must be made up before distributions can be made to common stockholders. Okay? So, here's the example. Let's suppose I didn't pay dividends on my cumulative preferred stock in 2007. I did not pay dividends on my cumulative preferred stock in 2008. And let's suppose because I had financial difficulties or I was short of cash. Now, let's suppose that 2009 is a great year for my company. And I want to start paying dividends to my common shareholders in 2009. But wait. Because I have previously issued cumulative preferred stock, and I have dividends in arrears from 2007 and 2008, before I can pay any dividends to my common shareholders in 2009, I have to pay the amount of preferred dividends in arrears from 2007, then from 2008, and then I need to pay the preferred dividends owing in 2009 before I can pay any dividends to my common shareholders. All right, now, Part 2A. Dividends in arrears are not a liability until they are declared. However, they should be disclosed parenthetically in the footnotes. So in my example here, I would not show a liability for the dividends that I did not pay in 2007. I would not show a liability for the dividends I did not pay in 2008. However, in the footnotes to my financial statements for 2007, I would say dividends in arrears or my preferred cumulative stock in 2007 are whatever that amount is. Similarly, in 2008, no liability would be shown on my financial statements. However, in the notes to my financial statements, I would say dividends in arrear on my preferred cumulative stock for 2007 and 2008 are. Okay? Number 3, convertible. This is convertible preferred stock. With convertible preferred stock, stockholders have an option of exchanging their preferred stock for a fixed number of common shares at a specified ratio. So conversion is usually accounted for at book value. So we're going to go over some journal entries on how to account for the conversion of preferred stock when we get to the problems at the end of the chapter. I think some of these concepts are best illustrated using numbers than just by talking about them. So let's flip to page 517. We're talking about callable preferred stock. All right, so now, before we get too far, where are we right now? Well, what we've just talked about is preferred stock, but we've covered 4 different kinds of preferred stock. We've covered participating preferred stock. We've covered cumulative preferred stock. We've covered convertible preferred stock. And now we're going to talk about, on page 517, callable preferred stock. And callable preferred stock is when the corporation who issued the stock has the option to repurchase their preferred stock at a specified price. If called, and again, we're taking the viewpoint of the corporation that issued the callable preferred stock. So if called, the corporation that issues the preferred stock does not record a gain or a loss on the income statement. Instead, any gains on this preferred stock are recorded in a paid-in capital account. Again, we'll see this, and I'll use when we get to the problems at the end of the chapter. Now, let's go to stock subscriptions. Stock subscriptions, or stock, can be subscribed by investors. And stock subscriptions are very similar to a magazine subscription. For example, with a magazine subscription, you pay $100 a year and you agree to purchase that $100 entitles you to receive one magazine every month, or however often the magazine is published. Very similar. With a stock subscription, you agree to purchase a certain dollar amount of stock. So again, either common or preferred stock. So again, we're looking at the accounting from the point of view of the issuing corporation. With a stock subscription, a receivable is established and stock subscribed is credited. When the total subscription price is received, the stock is issued. And this is an important point. We may subscribe to purchase a large amount of common or preferred stock over a 5-year period. Well, every time we make a payment over this 5 years, the corporation who receives the cash is going to debit cash and credit common stock receivable, or stock subscription receivable. And it is only when the stock has been fully paid for, or when the subscription has been fully made, will the stock actually be issued. And in that case, we would debit common stock subscribed and credit common stock. Okay? Now, one point I want you to look at is, at the time of the subscription, we are only crediting common stock subscribed for the par value of the shares being issued. However, at the time of the subscription, we still will be crediting paid-in capital in excess of par for the difference between the subscription price and the par value of the stock being subscribed. Okay? Again, we'll see this when we get to the problems, but please make note of that. Part C also talks about default and if returned. I don't think those are really that important of concepts. I would read them, but they're not that big of a deal. Now, let's go to treasury stock transactions, because treasury stock transactions are very important. Sometimes they confuse people. Part D, page 517. When a firm's own stock repurchased on the open market is known as treasury stock. So let's say I'm a firm and I believe that my stock price is too low. Well, what I'll try and do is I will go into the open market and buy back some of my stock. Treasury stock, key point here, is not an asset, as a firm may not own shares of itself. Instead, treasury stock is treated as a reduction of stockholders' equity. Okay? So, here's something to keep in mind. Our treasury stock account. Here's what our treasury stock account looks like. Our treasury stock account has a debit balance. However, our treasury stock account is an equity account. And the normal balance of our equity accounts are credit balances. Therefore, because our treasury stock account has a debit balance, it represents a reduction in our stockholders' equity. Okay? Please keep that in mind. Now, bottom of page 517, top of page 518. There are two methods of accounting for treasury stock: the cost method and the par value method. Under the cost method, top of page 518, treasury stock is debited for the cost of the treasury stock. So if I buy back my treasury stock at $38 a share, I'm going to debit my treasury stock account for $38, and I'm going to credit cash for $38. Now, this is a misnomer. Again, I'm at the cost method. It says that any gain or loss is recognized at the point of sale. However, such gains and losses are not recorded in the determination of income. Gains are credited to paid-in capital from treasury stock transactions, and losses should be charged first to paid-in capital from treasury stock transactions or paid-in capital from stock retirement to the extent that either of these exists for that class of stock. The remainder of any loss is to be charged to retained earnings. Okay, so let me explain this. All right? Here's what I mean. Let's suppose I repurchase 100 shares of my stock for $15 per share. Okay? So, what am I going to do? I'm going to debit treasury stock for $1,500. I'm going to credit cash for $1,500. Okay, so here is my treasury stock account. Now, let's suppose later on I resell 50 shares for $17 per share. So notice, I bought them back at $15. I'm now selling them at $17. So I'm kind of getting a gain of $2. But this is what I would do. Well, 50 times $17 should be $850. So I'm going to debit cash for $850. I'm going to credit my treasury stock account for the original cost of these shares. I originally bought these all 100 shares for $15, so 50 times 15 is going to be $750. So I credit treasury stock for 50 times 15, which should be $750. And then I'm going to credit, because this is a gain, paid in capital from treasury stock. Credit paid in capital from treasury stock for $100. All right, now, let's now assume, so this goes down by $750, and now the balance in the account is $750. Now, let's assume that I resell the remaining 50 shares, because I have 50 shares remaining after I reissued them. Let's assume that I sell the remaining 50 shares for $5 a share. Okay, I sell the remaining 50 shares. Sell remaining 50 shares for $5 per share. Okay, so first of all, I'm going to debit cash for 5 times 50, which is $250. I'm going to credit my treasury stock account for the original cost of these 50 shares. I originally paid $15 for these shares. So I'm going to credit my treasury stock account for $750. Now, the loss, so now I have a $500 loss on this treasury stock transaction. So the loss is, that $500 loss is first going to be applied to any balance existing in my paid in capital treasury stock account. Well, there's a $100 balance in there, so I'm going to debit paid in capital treasury stock account for $100. However, I still have $400 of the $500 amount of the loss to absorb. So what I'm going to do is I am going to debit retained earnings for the remaining $400. Okay? Debit, 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 credit of $750. And this account is going to have a zero balance now. Okay? Now, that's the cost method. Then there's the par value method. Under the par value method, all capital balances associated with the treasury shares are removed upon acquisition. So basically what we're saying is, when you use the par value method, your journal entry to record the purchase of treasury stock is the opposite to the journal entry that you would have made or that you made when you actually issued the treasury, when you issued the shares. Okay? So initially when you issued the shares, you debited cash, you credited par value, you credited paid in capital in excess of par value. Well, under the par value method, when you are buying back stock, you would debit treasury stock. You would debit common stock par value. You would debit contributed capital in excess of par value and credit cash, as you're shown in the middle of page 518. Okay? Look at these two examples, compare these two examples, because you will have to know them, and we'll do some problems at the end of the chapter which illustrate this. Okay, retirement. Part E, retirement of stock, again on page 518. Formal retirement or constructive retirement of stock is handled very similar to treasury stock. When we formally retire the stock, we debit our common stock par value account, we debit our paid in capital in excess of par account, we credited treasury stock, and then our debit to retained earnings is really like a plug account for any difference between the initial two debits and then the credit to treasury stock. Okay? Part F, dividends. Please know this. This is, and I'm sure you probably already know, at the date of declaration, an entry is made to record the dividend liability. Now, here's what I want to point out. F really refers to cash dividends. because you'll see later when we talk about stock dividends. With a cash dividend, the company issues cash to its shareholders. With stock dividends, a company does not issue cash, it issues additional shares of stock. So F, at the bottom of page 518, really refers to cash dividends. So at the date of declaration, a cash dividend becomes a liability of the corporation. Page 519, no entry is made on the date of record. And then number 3, at the payment date, the liability is paid. So there are 3 dates that you need to be aware of for a cash dividend. The date of declaration, that is when the dividend becomes a liability of the corporation. The date of record, in which no entry is made. The date of record just tells shareholders, look, if you're listed on the corporation's books as a stockholder on this date, we're going to mail a check to you. That's what the date of record is, so no entry needs to be made. And then we have the payment date, and that's when the actual cash is mailed out to the shareholders. And that's when we would reduce the liability by debiting dividends payable and then by crediting cash. Okay? Number 4, property dividends are accounted for similar to cash dividends. They are recorded at the fair market value of the answered transfer, with a gain or loss recognized on the difference between the asset's book value and the fair market value. So we would record a gain or a loss on the income statement if we declare a property dividend. 5 and 6 talk about liquidating and scrip dividends. Those are really not that important. Read them over. You'll get one question maybe at the most on them. Not that important. 7, however, is stock dividends. Unlike cash and property dividends, stock dividends are not a liability when declared. So they can be rescinded. So look at this. Notice that at declaration, the only thing that you're doing is you're debiting retained earnings, you're crediting stock dividends distributable for the par value of the shares being issued, and then you're crediting paid in capital in excess of par for the difference. And then at issuance, you just debit stock dividends distributable, credit common stock. Now, Part D of 7 is a very important point. You charge retained earnings for the fair market value of a stock dividend if it's less than 20 to 25% increase in the stock outstanding. You charge retained earnings for the par value of stock dividend if it's greater than 20 to 25%. Okay? Here's what we mean by that. When a company declares a stock dividend, it is either classified as a small stock dividend or a large stock dividend. Okay, so let's assume that the corporation has 1 million shares outstanding. $1 million shares outstanding, $1 par value, market price of $25 a share. Okay, now, a large stock dividend is when the corporation issues, for our purposes, more than 25% of the shares currently outstanding. So let's suppose that our corporation decides to issue in the form of a stock dividend 300,000 additional shares. 300,000 additional shares. Well, there are 1 million shares outstanding currently. 300,000 additional shares represents an increase of more than 25%, actually represents a 30% increase. In this case, this would be classified as a large stock dividend, and we would debit retained earnings for the 300,000 share, for the par value of the 300,000 shares being issued. So we debit retained earnings of 300,000. We credit common stock distributable of 300,000. Okay? Large stock dividend. Small stock dividend. Let's suppose that the company decides to issue 15,000 additional shares. 15,000 additional, not dollars, 15,000 additional shares. Well, 15,000 of 1 million is only 1.5%, which should be only 1.5% of the number of shares outstanding. It is. Okay? In which case, we would value this stock dividend at the market price of the shares on the day that they are issued. So, if I take 15,000 times 25, I would debit, this is a small, I would debit retained earnings for 15,000 times 25, which would be $375,000. I would credit common stock dividend distributable for the par value of the shares, 15,000 shares times $1. And then I would credit paid in capital in excess of par for the difference, which would be $360,000. Okay? Know the difference between a large and a small stock dividend. Now, 519, stock splits. Stock splits change the number of shares outstanding and the par value per share. Par value is reduced in proportion to the increase in the number of shares. The total par value outstanding does not change, and there's no charge to retained earnings. So therefore, because none of the stockholder equity, none of the balances in our stockholder equity accounts change as a result of the declaration and payment of a stock split, then no journal entry is required. So let's suppose in my example, let's suppose in this example that I used, the company declared a 2-for-1 stock split. Let's suppose that the company declared a 2-for-1 stock split. Well, that would mean that instead of there being 1 million shares outstanding, 2-for-1 stock split, there would be 2 million shares of stock outstanding, and the par value of each share, instead of being $1, would be 50 cents per share. So again, notice total stockholders' equity does not change. Okay? All right, so now let's move on. Let's look at appropriations of retained earnings on page 520. An entry to appropriate retained earnings restricts the amount of retained earnings that is available to dividends. So you just create, notice, the credit reserved for retained earnings. That is an appropriation account. Just keep that in mind. Share-based payments. The accounting for this has changed. And when we talk about share-based payments, we're talking about stock-based compensation. So for letter I, just read this information. because I'm not so sure how thoroughly they'll test it because of the recent changes in this area. All right, so now let's go on. Look at J, accounting entries for share-based payments on 521J. Just know the journal entry for that. Again, I don't think they're really going to test this that much. All right, now let us move on to K, basic earnings per share on page 523. This is very important. You need to be able to know how earnings per share is calculated. Okay, K, as it says, first thing, CPA candidates must be able to compute both basic and diluted earnings per share. In addition to the computations, candidates should also understand the presentation and disclosure requirements. Okay, so you got to know this. The objective of earnings per share is to measure the performance of an entity over the reporting period. Required presentation calls for a basic EPS in all situations and a diluted EPS in those situations where an entity's capital structure includes potentially dilutive securities. And what do we mean by potentially dilutive securities? We're talking about convertible bonds, convertible preferred stock, stock options, and stock warrants. These are all potentially dilutive securities. And when we say dilutive, what it means is if additional shares are issued as a result of the options, the convertible bonds, the convertible preferred stock, it means that it will reduce our earnings per share calculation because there will be a greater number of common shares outstanding. All right? Again, I'll explain a little bit more when we do problems. Okay, now, basic and dilutive, I'm still on page 523. Basic and dilutive earnings per share amounts must be presented on the face of the income statement for two elements: income from continuing operations as well as net income. In those situations where an entity also reports discontinued operations, extraordinary items, and or the cumulative effects of an accounting change in principle, the entity may report EPS on the face of the income statement or disclose such information in the footnotes. Okay, so here's what happens. You get income from continuing. You have to show EPS there. Then you have discontinued, extraordinary, cumulative effect of accounting change, and then you have net income. Well, a corporation must show this EPS and this EPS. It can show this EPS, and this EPS, or the effect, actually, let me say that again. It can show the effects of these three things on EPS, either on the face of the income statement or disclose it in the footnotes. All right, so now, again, I'm in the middle of page 523. Public corporations begin by computing basic earnings per share. In this calculation, only those shares of common stock outstanding, and it should be currently outstanding, are included. Any potential issuance of securities as a result of convertible bonds, convertible preferred stock, warrants, or stock options is ignored. So that's how we calculate basic EPS. Now, a couple of things to note. The numerator is net income available to common shareholders. So the numerator reflects the deduction of preferred dividends already. Any preferred dividends declared in the period on non-cumulative preferred stock are subtracted. In addition, the dividends accumulated for the period on the cumulative preferred stock, whether or not declared, are also subtracted. Okay? So again, look at this example. It's very, very important for you to be able to calculate basic earnings per share. Now, let's turn to the top of page 524. When calculating the amount of the numerator, the claims of senior securities preferred stock should be deducted to arrive at the earnings attributable to common stock. It should be deducted. In the example, the preferred stock is cumulative. Thus, regardless of whether or not the board of directors declares a preferred dividend, holders of the preferred stock have a claim of $6,000 against 2008 earnings. Therefore, it should be deducted. Cumulative preferred stock dividends are always deducted whether or not declared. So just go through this example in the middle of page 524. Now let's talk about diluted earnings per share. Diluted EPS measures the performance of the entity over the reporting period while also taking into account the effect of all dilutive potential common shares that were outstanding during the period. The only difference in the computation of diluted and basic EPS is that the denominator of the diluted EPS computation is increased to include the number of additional common shares that would have been outstanding if the potentially diluted common shares had been issued. So when we're calculating diluted EPS, we're really playing a what-if game. What if the shareholders had converted their bonds into shares of common stock? What if holders of convertible preferred stock had converted their preferred stock into shares of common stock? What if holders of stock options actually exercised their right to purchase additional shares of stock from the corporation? Again, it's a what-if game. All right, diluted EPS, again, I'm at the bottom of page 524, should be based on the security holder's most advantageous conversion rate or exercise price. Similar to basic EPS, all anti-dilutive securities are disregarded. So, let's suppose we assume that convertible bonds are converted into common shares. Once we do the calculation, assuming that the convertible bonds have been converted into common shares, if we arrive at an EPS number, assuming conversion, that's higher than our original basic EPS number, then this would be anti-dilutive, and we would not include the assumption that these convertible bonds had been converted in our diluted EPS calculation. Okay? Very important to keep in mind. So, I want you to read over this information at the bottom and in 524 because they go into good detail. Now, here's something else I want to talk about. In the middle, the numerator of the EPS calculation covers a particular period of time, such as a month, a quarter, or a year. It is therefore consistent to calculate the average number of common shares were outstanding during this same period. So, the calculation below in Table 1 illustrates the determination of the weighted average common shares outstanding. Note that for stock dividends, the number of shares is adjusted retroactively for the shares which were outstanding prior to the stock dividend. So, this is what we mean. Since the stock dividend was issued after the issuance of additional shares for cash on April 1st, the shareholders of those additional shares and the shareholders of the shares outstanding at the beginning of the year will receive the stock dividend. So, what we're saying here is, if the stock dividend is declared during the middle of the year or at any time during the year, all of the shares outstanding prior to the date of the stock dividend would be adjusted, because everybody who owned the stock prior to the date of the stock dividend would receive the additional shares. So stock dividends are done retroactively to the beginning of the year. Now, at the bottom of Table 1, it says, in the weighted average computation, if common shares are issued in a business combination during the year, the common shares are weighted from the date of issuance. So there are various complications for calculating the weighted average common shares outstanding, but again, once you go through a number of problems, they're really not, these complications are really not as difficult as they may seem. Okay, so now let's go on to page 525. 525, they show you in the middle of 525, it's called the treasury stock method. All right, so at the middle it says the calculation of diluted EPS is based upon outstanding common stock and all dilutive common shares that were outstanding during the period. In the example, the options and warrants are the only potentially dilutive securities. Options and warrants are considered to be common stock equivalents at all times. So if there are options and warrants available, they will generally always be dilutive and should be included in the diluted EPS calculation. Consequently, the only question that must be resolved is whether or not the options and warrants are dilutive, and as I said, in most cases they generally are. Okay? Now, this question is resolved by comparing the average market price per common share of $10 with the exercise price of $8. If the average market price is greater than the exercise price, the effect of assuming the exercise of warrants and options is dilutive. However, if the average market price is less than or equal to the exercise price, the effect of assuming the exercise of options and warrants would be anti-dilutive. So, the key issue here is, when you have options and warrants, you look at the average market price of the stock and compare it with the exercise price of those options and warrants. If the market price or the average market price of the year is greater than the exercise price of those options and warrants, it's going to be dilutive. All right? All right, let's go on. 526, again, they show you how to use the treasury stock method. So what you're going to assume is the options and warrants are exercised. When options and warrants are exercised, it means that the holders of these options and warrants are going to give the corporation the exercise price, the cash exercise price of the options and warrants. In return, the corporation is going to issue the stock. But remember, this whole diluted calculation is a what-if example. So using the treasury stock method, we're really saying, what if these options and warrants were exercised? What if the corporation receives cash in return for the exercise of these options and warrants, and in turn goes out and issues these shares? What we're then going to say is, what if the corporation takes this hypothetical cash that it receives from this hypothetical exercising of options and warrants and goes out and buys back additional shares outstanding with this cash? How many shares eventually will be left outstanding as a result of the corporation using this hypothetical cash to go back and buy additional outstanding shares? Okay? That's really what we're saying here. And sometimes it's a little bit easier to read than it is for me to say. But again, I want you to keep in mind, this whole diluted EPS calculation, including this treasury stock method, is a what-if calculation. What if the convertible bonds, the convertible preferred stock, was converted? What if the additional shares of common stock were issued if the options and warrants were exercised? All right? Read through this example. All right, 527, again, they give you, this gets a little bit complicated, but again, follow this example. It's very, very good. All right, that's 527. It continues on. Take the time and read through this example. Okay? Page 528, corporate bankruptcy. Now, just know this information about corporate bankruptcy and the order. I'm on page 528. I'm on the middle. The order in which assets in the statement of affairs classifies assets in the following order of priority from highest to lowest. You need to read this information and just know the priority of claims. Okay? Look at this. Equity interests are classified in the following order from highest to lowest. Preferred claims, fully secured creditors, partially secured creditors, unsecured creditors, and then stockholders. So that's why stockholders are sort of viewed as the residual claimants of a corporation, because they are at the bottom of the totem pole. They get what's ever left over of the cash after everybody else has been paid off. Okay? Reorganizations. I would read this information about reorganizations and quasi-reorganizations. Again, you'll be asked, if anything, one or two qualitative questions on reorganizations or quasi-reorganizations, but you do not have to know this in as much detail as you do the earnings per share calculations. Turn to page 531. ESOPs, employee stock ownership plans. Again, know what they are, not a big deal. At the bottom of page 431, know these ratios. Again, you don't have to memorize them. They have enough questions in the end of the chapter that if you do enough of these problems, then you'll know what these calculations are. Dividend payout, book value of common stock, rate of return on common stockholders' equity. Okay? And again, let me talk to you a little bit on page 532 about this research component, because stockholders' equity is the type of topic that they can ask a simulation on. A simulation as in a problem, or a simulation for you to actually go into the accounting pronouncements to find supporting documentation. So, I'm on page 532. Stockholders' equity includes a variety of transactions and accounts that have been addressed in many different accounting pronouncements. From a historical point of view, as the equity transactions have become more creative, additional pronouncements were passed to address the issues created by these more complex financial transactions. So they give you a brief listing of topics and the accounting pronouncements. The most effective way to research such broad topic areas is to focus upon key words in the particular research topic. Now note that in some of the older literature, keywords in the authoritative literature may not be the same words that we would see today in the newer standards. So again, just review these definitions and the difference in some of the terminology that's used. Okay? So now I'm almost finished with Module 13. I've covered what you need to know in the text. And in the second portion, I am going to go over the problems. But I do want to emphasize to you that I think from a quantitative point of view, the most important topic that you're really going to have to study and learn is the calculation of earnings per share, basic EPS and diluted EPS, and the use of the treasury method. Do as many problems as possible at the end of the chapter, and then review every single one of the answers that pertain to these problems, because by doing the problems and studying the answers, that represents an additional study tool for you. So when we come back, we will hit the problems. See you in a